We got quite a bit on right now, so I think I'm just going to go ahead and kick it off. So this is our Elevate webinar. Like most, we've replaced our meetups with a webinar, and we haven't seen many talking about passive investors and what's going to happen with their investments, the good, the bad, and possibly the ugly on the effects from coronavirus. So I've also got Dugan, Kelley, Haley, Gant, and Eric with me. I'm going to go through a couple slides, and then I'm going to bring in the experts in their field. Haley's going to speak about retirement funds and how that's looking right now, some of the benefits with this coronavirus, and then her overall take on the market and investments right now. And then Dugan's going to come and talk about the ugly stuff that people try to avoid talking about, but he's going to inform us on some of that. So I'll go ahead and get started. I wanted to start with a general, where do we stand as far as coronavirus? Things have been changing daily. I even, I wrote some of these notes a couple of days ago, and some of it has already changed. So in general, the stock market has started to do a little bit better. I know it had a hit, I believe it was yesterday, but definitely looking better than where it was when this first started. As far as the capital markets, I mean, for the most part, they're pretty frozen still. Freddie and Fannie are still doing some loans, and you've got some regional banks trying to step in and do some loans that in the past they would be getting, beat by Freddie, Fannie, or some of the bridge loans. Social distancing appears to be working. The CDC said on Monday that we should be nearing our peak. And then yesterday, Trump said we were past the peak. Whether that's accurate or not, I'm not sure, but we're definitely either near the peak or past the peak. 16.8 million Americans filled out unemployment since mid-March. Pretty big number, and unfortunately, that's probably going to continue to increase. The Treasury announced that 80 million people should be getting their stimulus payments this week. And I do know several have gotten it. And then there's been a ton of applications submitted for the PPP and EIDL loans. I've heard of a couple businesses getting the PPP. I have not really heard much about the EIDL. I guess in the chat, if any of you have know of somebody that's gotten these loans, I'd be curious to know. So if you can put it in there. And then, as far as the plan on how we open everything back up, so there hadn't been much talk about this, and I kept asking questions about it. It seemed when I started really talking more about the plan, and then Trump announced today that he's going to be doing a conference later tonight on how that's going to roll out. So I'm really curious to see what they have in mind. As far as what I think, I think most signs are pointing more towards June really getting things opened up. I know there's been talk about May. Maybe they're going to open some stuff up in May, but June is what I think when we'll really start ramping up, and it's not going to be a light switch. We're not going to just turn it right back on. Then there was a new model that came out sometime this week saying that there will be no more deaths after June 21st. And then the economists are optimistic, saying that we'll bounce back later this year. So then I want to skip over to the good. So April collections have come in, and they're looking pretty strong, stronger than most expected. I think a lot of operators got in front of it. and overall, it seems like residents realize how important it is to pay their rent and have somewhere to live. So that's a good sign. Overall, multifamily has fared better than other real estate classes during the last recessions, so that's a positive. Net operating loss for 2018 to 2020 can now be carried for 5 years. Haley's going to talk about this a little bit more, but there's no penalties for taking out up to 100K from your retirement funds, and you can also loan up to 100K against these versus I believe it was 50K before. Then on a typical deal, at least us as operators, we usually like to have our break even on occupancy somewhere around high 60, 70% range from what came in April. That's looking pretty good. Overall, the Elevate team, we continue to be pretty bullish on multifamily real estate. People are always going to need somewhere to live. And then as far as the assets that we purchase, we try to provide a clean, modern space with maybe not all the amenities of newer built complexes, but some of them, and then offer the rents at 30 to 50% less than they would get at a new complex. So with that said, we feel like the demand is going to be there. Regardless of the market cycle that we're in, we feel pretty confident that we can still add income to our properties. And, higher income is always going to be valuable to future buyers, even if the cap rates are not going to be as compressed as they've been. There's definitely going to be some opportunities. We've already started seeing some of those, and we're taking action on them. I honestly believe the window of opportunity is going to be smaller than some think. That is, if we do have a good plan of how to get out of this. The market was in a really strong place, especially the multifamily. I just feel like the opportunity is going to be, I don't know. I can't say how long without, really seeing how long this is going to take and what the plan is to open everything up. But with that said, we're gearing up to take advantage of these opportunities and get some good deals. So now I'm gonna. Oh, sorry. One more thing on the good is this came from NMHC. It's a rent payment tracker that they put a bunch of the industry software companies to come up with this. And what you're seeing right there is in April, ending the 5th, ending, what is this, 84%. Shoot, I can't see the slide. My own slide's being covered by the windows of the other hosts. But it's not off as much as others thought it might be. Even Class C, everybody was talking about Class C was going to be worse than B and A, and it was just a few percentage points off. They also mentioned, so this was a webinar yesterday hosted by the NMHC, and they also mentioned that they're thinking, with all the government money coming in now, with the grants and with the stimulus, that should carry us over to May, to having a decent month of May as far as collections. So that's also pretty positive. Now, getting into some of the bad stuff, there could be some investors and some deal sponsors that are going to be in trouble here. What that looks like, if some of these deal sponsors were aggressive in the underwriting and in their assumptions, if they didn't account for any reserves or not enough, if they purchased at above retail prices, and didn't structure their purchase for a long-term investment. So, I've seen it a lot. There's a lot of, well, was a lot of operators purchasing at or even above retail pricing. If they've got a loan coming due soon, I mean, there's no way they're going to get those retail prices now. So that could lead to an issue. Um, then if they have overall poor asset and property management, especially right now with collections, you've really got to be on top of both of those. You got to have a good property manager. If it's in-house, then you've got to have good systems in-house. And then if you have a third-party property manager, you've got to have good asset management. You got to be on top of them, and you got to look at your KPIs, and you got to look at those weekly, I mean, even daily right now with the collections. And then, making sure that they're flexible and they're open to adapting. Um, Even showing units right now, and obviously a lot of things are going to online. So if somebody's not willing to adapt quickly, they could be left behind. I would say definitely no distributions right now till we really know more. Unless you have a asset that's maybe, I don't know, most of your tenants are medical or something. Then maybe I could see distributions happening there. There's not going to be any evictions. Um, there's going to be a lot less traffic. There's going to be, unfortunately, some residents taking advantage. Some that they do have a job and they're still trying not to pay their rent. There's also some bad information about that going around, which in the next slide, I'll show you guys some of that. And then as a deal sponsor, we got to make sure we're communicating with our residents and giving them the correct information and resources they need. Then capital calls, I think this needs to be something that comes before forbearance. The forbearance right now, the terms they have are just not something that's really going to help at this point unless they change some of that. But as far as the capital calls, as an operator, you should come up with an estimated negative monthly cash flow you're going to have on your property, and then probably multiply that at least by 3 times. And then, when you take that number and you divide it up between your investors, it should come out to a small number. And then Dugan later on will cover this a little more in depth as far as what that would look like. Then, give me 1 second here, guys. Hold on. I've got to move there. Okay, so as far as the capital markets being frozen, it's going to be a lot harder to get financing right now. I don't know how long that's going to last. It's going to depend on how we open up the economy and what that looks like, but that's going to drive the cap rates up, and it's going to obviously lower the values of the properties. The question really is, but for how long is that going to last? And then as far as a passive investor, you should expect your cash on cash returns to take a hit right now. But as long as the sponsors don't run into any major issues, I see the overall returns shouldn't take that big of a hit. This is some of the stuff that's going around as far as misinformation to residents. These are organizations that are pretty much putting together information for the residents, telling them not to pay their rent, that they don't need to pay, and to go on a rent strike. And then they're posting it all over multifamily properties. So this is why, one of the reasons you need to have constant communication with your residents. Make sure you're giving them the proper information. The last thing a resident wants to do is not pay their rent, and then coming out of this, they have once we can do evictions, they get evicted and they can't get caught up. That's not going to be good. Now getting to the ugly. So no haircuts. I've heard a lot of people panicking about this. You know, I don't know. I don't see the issue, but some people do. But no, the true ugly. Give me one more sec. All right. So May and June collections, right? Like I said, April came in fairly good. I think it was 84%. We don't know what May and June are going to look like. You know, the unemployment's going to continue to go up. And you know, however, like I reported, the NMHC thinks that the stimulus money and the government grants coming in, that should help for collections in May. Like I mentioned before too, you know, the prices could possibly start dropping. Then the banks will decrease the leverage and their terms won't be as favorable. People will lose more jobs and tighter lending requirements. So I'm not saying this is all going to happen, by the way. You know, this is what I consider the ugly. So if this continues longer than some expect and we don't have a good plan when we open up for business, pretty much, this is what I can see happening. Forbearance, like I mentioned, you know, I think this should be last resort. Since they rolled it out, I think there's only been maybe 100 borrowers that have gone this route, and it's just with no evictions. I think it's no evictions till you actually get caught back up. That could be pretty rough for somebody that's trying to, you know, properly manage a property. Then past forbearance, you've got, you know, default of the actual loans, bankruptcy, foreclosure, eventually investors losing their investments if all that happens. So, you know, obviously that said, that's the last thing any syndicator, any deal sponsor wants to happen. Unfortunately, if things do get ugly, and depending on how that operator, what decisions that operator makes, it's possible. So I'm just trying to be, you know, 100% transparent with you. Like I said, these are worst case scenarios. Now, with all that negativity, I do want to say that, you know, we do think that this will not happen for the majority. Maybe in areas where that area is industry specific to industries that got hit really bad. I think it's going to be mostly there. And then we also do see some opportunities in those areas. We're still extremely bullish on multifamily. I actually think this is going to overall bring in even more capital looking at multifamily, because you know, when it's all said and done, people are going to look back and they're going to see that multifamily didn't fare that bad compared to others. You know, obviously the stock market, oil, those two have taken a huge hit. And then in the U.S., you know, we still have a huge demand for affordable housing, especially workforce housing, and then even overall multifamily housing. So with that said, I'm going to let Haley take over, and she's got a PowerPoint as well.
Perfect.
Let me, all right, see if you can get yours on there, Haley.
Here we go. Okay, perfect. Can you see my screen?
Yep.
Perfect. So hello, everyone. You've got me for about the next 30 minutes. And for those of you guys who don't know me, my name is Haley Gant, and I'm an IRA specialist at Quest Trust Company. Quest is a self-directed IRA custodian based out of Houston, Texas. That's where I'm located here. But we have clients all over the country, and we really specialize in teaching investors the ins and outs of investing with self-directed IRAs and how to truly diversify your retirement portfolio. I've been with Quest for about 4 years now, but I come from a family of real estate investors. My parents have actually been Quest clients since 2004. So I'm, grew up in the industry, very familiar with it, basically had no choice but to grow up surrounded by everything. So let's see here. Next slide. Okay, perfect. So just kind of a quick intro of what I'm going to cover today. I'm going to do just a quick run through of the basics. Who is Quest? What do we do? And how can we help you save more for retirement? I am going to also talk about the CARES Act, which is new recent IRA legislation that has been passed with this new stimulus bill. And then last but not least, I'm going to talk a little bit about how to really maximize your upcoming investment opportunities with your IRA funds, as well as upcoming opportunities of raising capital from other people's IRAs and how that really applies to today's market. I know we've got quite a bit of you online right now, so if you have questions, I do enjoy for my presentations to be interactive, so feel free to drop any questions in the chat box and I'll get them answered for you live here on the presentation. And last but not least, on this screen right there at the bottom is our disclaimer. We don't give tax, legal, or investment advice. I'm not a licensed financial advisor. We give a lot of education about self-directed IRAs and your different investment options, but definitely encourage you to consult your attorney, CPA, do your due diligence, and all of that fun stuff. So who is Quest Trust Company? We're the nation's fastest growing self-directed IRA company. We've been around for about 16 years. One of the biggest differences between Quest and other IRA custodians is we hold non-traditional assets. So our clients use their IRAs to invest into real estate, promissory notes, and private placement investments. And we specialize in teaching you guys how to do it, the whole process, pretty much A to Z. We are one of the larger custodians in the country. We have about $2 billion in assets under management and about 17,000 clients nationwide. Every day, whenever we close our doors, there's about $300 million in undirected cash just sitting in our clients' IRA accounts. And that is money that is sitting in an IRA waiting to be invested. So there's a lot of people out there looking to place their IRA funds into safe and secure investments outside of the stock market. So, it's a huge thing we teach about on a regular basis. And now within the past couple of months, all of this coronavirus craziness kind of changing the way all of our day-to-day functions are. I personally think that these principles and things that you can do with a self-directed IRA are more important than ever. We do a lot of education. I've probably done about 6 webinars in between last week and this week, but we do free classes every single week on our Facebook page, on our YouTube, and through Zoom through our website as well. So we've got a ton of information for you. This picture here is actually the founder of Quest, Quincy Long, and his brother Nathan. They serve as our CEO and president, and this was at last year's Quest Expo, which this year, unfortunately, we're not able to host, so it will be online, I believe, in June. Should have some more information coming out shortly about that. So what is a self-directed IRA? Again, what's different about what we do at Quest? There's really no legal distinction between the IRAs that we hold at Quest and an IRA that you have at any other custodian. So the IRA accounts are exactly the same. The only difference is the types of investments that your custodian allows you to invest in. So if you have an IRA at Fidelity or Charles Schwab, they are going to specialize in holding publicly traded assets, such as stocks, mutual funds, and other publicly traded securities. At Quest, it's the exact opposite. We allow our clients to use their IRAs to invest into real estate investment properties, rentals, flips, multifamily, commercial deals, and promissory notes as well. A lot of people like to use their IRAs to invest passively and be either private lenders or invest passively into multifamily and commercial syndications. So when you hear self-directed IRA, that's honestly really just a marketing term. The IRAs are actually exactly the same. Why is this important? So there's a lot of reasons you would want to have a self-directed IRA. And again, with all of these recent developments and the volatility in the stock market, which is always there, we just kind of get reminded every once in a while when it takes a 30% dip in 2 days. But why is this important? You always want to make sure that you have your investments diversified, whether that's in your retirement account, outside of your IRA. But the reality of it is 98% of Americans only have their IRA invested into publicly traded assets. Those are things like stocks and mutual funds, basically pieces of paper that you have no control over what happens with that investment tomorrow. So we really like to teach people how to use their IRAs to invest into tangible assets, such as real estate, notes, private placements. So you're really able to hold different types of assets in your IRA. Kind of going along with that, why is this important? The tax savings. So your IRA gets special tax advantages that you don't get as an individual. As an individual, you are always going to be a taxpayer. So if you're making decent money, you're going to pay anywhere from 20 to 40% of your income back to Uncle Sam each year. Your IRA is technically a tax-exempt trust that does not pay those income taxes or capital gains taxes each year. So it's a really great way to hold some of your different real estate types of investments within this IRA, within this tax-sheltered account, and then use the money in your IRA to invest into the things that you are knowledgeable about. I know most of you guys watching this probably are not experts in the stock market. You are real estate investors, or you are looking to get involved into real estate. So you might as well use this money that you have sitting in an old 401k or IRA that gets these awesome tax advantages to invest into the things that you are knowledgeable about or interested in or even specialize in as a real estate investor. So again, all of these things are super important, and especially in today's market when things are rapidly changing, you always want to make sure that you know all of your options out there for your retirement funds. Not going to spend a lot of time on this slide. This slide, usually with the 7 types of accounts, we spend anywhere from 20 to 30 minutes on this slide alone in our presentations. We have 7 different types of accounts at Quest that you can self-direct. Knowing really the ins and outs of which accounts you can make contributions to, which account you should open to move your funds into Quest, that is really where a one-on-one consultation with an IRA specialist such as myself is really, really vital. So my job as an IRA specialist is to help walk you through all of these different types of accounts, how your money moves into Quest, the different investment options, the different tax advantages, and how you can use all of these accounts together to partner in on your deals or use multiple IRAs from you and your immediate family to invest together and grow multiple buckets of money, tax deferred or completely tax free. I do want to touch on these specialty accounts. Now, these accounts are really awesome because they can be self-directed just like all of our other IRAs, but the distributions can be taken out completely tax-free before you hit retirement to pay for educational expenses with the CoverDell account or any qualified health expenses with a health savings account. Those can be self-directed just like all of our other IRAs, but you can access the distributions completely tax-free before you're 59 and a half. So it's all about kind of knowing these different types of accounts that can be utilized, self-directed, and leveraged, knowing how they work together, and really having a main point of contact, such as myself, that's an expert in all of these types of accounts. So I can kind of hold your hand through the process as you're getting started and figuring out how everything works. Again, what types of accounts can be self-directed? All of them. This is my email right here. I have put it in a lot of these slides. So if you guys are interested in a consultation, send me an email. Especially as we're all working from home, I'm doing consultations pretty much all day, every day. So it is best to set up an appointment to do that. Send me an email, and it's really easy. I can take you through the whole process. So this slide right here, I think, is really important because it's kind of a different concept of thinking. Now, I'm not sure if the videos are in front of the title, but you're not missing too much important information there. But basically, this is kind of 2 different schools of thought. So you want to think of whenever you're learning about self-directed IRAs and all of these different investment options, you can apply these to your IRA to help you build tax-free wealth for your retirement. but there's also a huge opportunity in utilizing other people's IRAs as private financing or private capital for your deals. So your IRA, if you take out that money before you're retired, you're going to be taxed and penalized on it. But you can self-direct it, grow it, put certain investments in your IRA to help you save for retirement. Now, for your deals that you have going today that you need capital for, that's where you can utilize other people's IRAs, or OPI as we sometimes like to call it. I would definitely recommend for all of you, start training yourself on how to have the conversation of either raising capital from someone else's IRA, or if you're looking to utilize someone else's IRA, maybe as a private money lending source for some of your deals that you have coming up. Start training yourself on how to have these conversations. The slide a couple of minutes ago, how many people have filed for unemployment? Like several million. Those are going to be people that a lot of them will have 401ks that are eligible to be rolled over. These people have also been recently probably slapped in the face by the stock market and have taken a huge loss and are really in recovery mode right now. So give me a call, shoot me an email, and I can kind of help to walk you through at least a good basic foundation level of how to have these conversations with other people in your network, other investors. That way you can not only grow your IRA for your retirement, but you can also help other people save for their retirement while you're also getting potentially unlimited sources of private capital for your deals. So again, email me, free consultations. I'm a nerd and all I do is talk about IRAs pretty much all day, every day. So here to help. Moving on to the CARES Act. This is recent legislation that has been passed kind of along with the stimulus bill. Thanks for moving those over for me. And the CARES Act, one of the biggest things about it is allowing people to take up to $100,000 out of your IRA, even if you're under 59 and a half, with no 10% penalty. Now, you do have to meet some certain criteria in order to basically self-certify yourself that you do qualify for this distribution. But as you'll see in the next slide or two, these guidelines are kind of very broad, and a lot of people will qualify for this distribution. I will let you know these next 5 slides are very wordy. I copied them directly over from a specific CARES Act presentation that one of our other specialists gave, but I wanted to leave the full verbiage of these slides in here. That way you guys can see it, but you probably don't have to memorize everything on these slides. If you have questions, just give me a call. 401k loans have been increased, as George mentioned. Required minimum distributions. If you are over 70 and a half or now 72 and a half, or if you have an inherited IRA, you have required minimum distributions that you are required to distribute a certain part of that IRA to yourself each year. Those have been suspended for the 2020 tax year. If you've already taken an RMD this year, you can put it back in with no penalty or anything like that. And also, as I was mentioning, the health savings accounts. Health savings accounts are really cool because they can be self-directed and grown just like all of our other accounts, completely tax-free, and the distributions can be used to pay for any of your qualified health expenses. In this bill, they have included any sort of coronavirus medical expenses are able to be covered by your HSA. So this hardship distribution, this is kind of the full verbiage of the slide. Again, I'm not going to be really reading this word for word, but if you have been affected by coronavirus in some sort of way, if you've been diagnosed with coronavirus, someone in your family, like a spouse or dependent, or if you have been laid off, work hours decreased, quarantined, furloughed, you qualify for this distribution. You can take up to $100,000 out of an IRA right now, and you will have no 10% penalty, but you also have up to 3 years to either put the funds back into your IRA and avoid paying taxes on it, or you have up to 3 years to pay the taxes on this distribution. Now, me as the IRA specialist wanting to really look out for the well-being of everyone's retirement, I would say don't take this distribution if you don't need it. Your IRA gets these really awesome tax advantages that you don't get as an individual. And, just because they're kind of giving the ability to take this distribution, really it's for the people in need that are really in a crunch, that, they don't have any income right now, things still need to be paid for. So they are giving you this ability to avoid the 10% penalty. But what I think is really cool about this is the fact that you have up to 3 years to put it back in. We're going to hopefully at least be in a very different world and market in 1, 2, 3 years from now. So just kind of think about the long-term plan accordingly. So if you are able to put these funds back into an IRA, it's essentially an interest-free loan to yourself, because you're not going to pay interest back to your IRA, but you have up to 3 years to put these funds back in and continue to grow it tax sheltered to save for your retirement. And again, if you guys have questions, it looks like Rick has a question. Can the funds be put into an IRA to avoid tax? Yes. So certain contributions to some of the accounts are tax deductible. If you're looking for like a big tax deduction, probably one of the best ways to do it is to make a contribution to one of the employer plans. If you are self-employed, for example, with a SEP IRA, you can put in 25% of what you pay yourself, up to $57,000 for this year, and that is tax deductible. Now, it's not exactly compatible with like a 1031 exchange. Give me a call and we can talk a little bit more about that. But there are some ways that you can make a contribution to an IRA and get a tax deduction on that. And again, this slide right here is just kind of the qualifications. You have to be diagnosed with COVID-19, a spouse or dependent, or financially affected in some way. Now, anytime someone calls in and they're asking us about this, we are taking the approach where, hey, this isn't just like a handout to give you access to your IRA because they want you to take it out. It is really for people that have been affected. But if you notice in these bullet points, there's going to be a lot of people that qualify for this. Just kind of a side note here, I am pretty sure that the people that write the legislation that passed the CARES Act are not the same people that write the IRS code. So there haven't been a lot of guidelines that have been released just yet. But throughout this year, I foresee that the IRS will be releasing a little bit more guidelines on this as far as the yearly reporting for the distribution. And I mean, the fact that you have up to 3 years to put it back in or spread the taxes out, that's probably not going to be the most simple reporting, fixing, going back for previous years. So just kind of keep that in mind as well. But there should be some more guidelines and guidance being released throughout this year. Now, this $100,000 distribution has to be taken before December 31st. So if you wait until next year, you're probably not going to be able to take this distribution and avoid the penalty, but just kind of keep in mind, it's any time from now through the end of the year that you can take the money out and qualify for this. With 401ks, if you guys have a 401k like through your employer, you do have the ability to actually loan to yourself from a 401k. Normally it is 50% of the 401k's value up to $50,000, whichever is the lesser of the two. They've slightly increased that where, you could loan your entire 401k to yourself, or you could loan up to $100,000 to yourself from the 401k. Now, one thing that I'm not sure of that I actually just thought of is if you have a 401k and an IRA, I'm not sure if you would be able to max out both of those distributions. But in all honesty, I probably would not recommend that because, the income that you're losing now probably isn't going to equivalent to $200,000, and you're really taking a big hit in your retirement account if you choose to take out that much. So just kind of keep that in mind, and as you're kind of going through these things. Again, RMDs, required minimum distributions, have been suspended for this year. They will resume next year, hopefully. Health savings accounts, again, these can be used to pay for any qualified health expenses completely tax-free. If you have a high deductible health plan through your health insurance, you qualify to make contributions to an HSA. And health savings accounts are really cool because when you make contributions to an HSA, that contribution is tax deductible. You can invest it and grow it. And as long as the distributions are used for qualified medical expenses, which is very broad, the distributions come out completely tax-free. And as long as your HSA is in place at the time that you pay for a health expense out of pocket, you could actually come back months or years down the line and reimburse yourself for that health expense completely tax-free. So if you have an HSA and you end up having a lot of medical expenses this year that you pay for out of pocket because maybe your HSA is a little small right now, pay for those expenses out of pocket, keep track of those receipts, then use creative investment strategies to grow your HSA. Then maybe 10 years from now, take all of that money out to reimburse yourself and it comes out completely tax-free. And again, that can be done before you're 59 and a half. So it's a really great way to leverage one of these tax sheltered accounts and be able to access that money completely tax-free before you actually hit retirement age. So just kind of remember, what should you know? Should you take a distribution from your IRA? Remember, this is a hardship distribution. This is not a freebie handout. This is really to help individuals in need, and doesn't necessarily mean that you should take the money out of your IRA, because you always want to weigh the opportunity cost of what this distribution is going to affect on you on the long run. I know the world has kind of been turned on its head in the past 2 months, but so a lot of our short-term needs and our daily activities have drastically changed from the beginning of the year. But keep in mind, you have short-term needs and you also have long-term financial goals. So if you choose to take a distribution from your IRA, you want to make sure that you still fall within meeting your short-term needs, but also not really jeopardizing your long-term plan for financial freedom. And retirement planning as well, just something to kind of keep in mind. If you take a hardship distribution from your IRA and you're not able to put the funds back in, I would just encourage you guys, don't get discouraged by that. There are still so many ways that you can educate yourself and utilize creative investment options to help either your own personal funds or your IRA recover and continue to grow once we get through all of this. I really believe that there are going to be a lot of investment opportunities coming up in the next couple of months. So you want to make sure that you have a plan in place for both your own funds and your IRA. And if you, kind of have questions, want to bounce some things back and forth, again, I can't give you investment advice, but as long as you understand that, I'll sit down and have a real conversation with you. I'll kind of tell you how I see things, maybe what we see clients doing commonly, and just kind of help to point you in the right direction. So upcoming investment options with self-directed IRAs, what do I see coming up in the future? Since we're working from home and, when all of this happened and everyone's working from home, everyone's getting laid off, opening up a self-directed IRA is probably not the first thing on a lot of people's minds. So as we were going through all of this, I was tuning into every webinar that I could get that I could come across, just to figure out what other knowledgeable and experienced real estate investors, what their ideas and opinions were for where the market is going. And I've been keeping up with those pretty much since this whole thing started, because I really enjoy learning and really seeing what's going on out there, so I can keep our education about self-directed IRAs relevant to what's actually going on. So some of the upcoming opportunities that I foresee is raising private capital from other people's IRAs is going to be a huge opportunity, not just in upcoming months, but right now. A lot of Wall Street money, a lot of banks and lending have either completely frozen up, or they are in the process of really raising their, qualifications and down payments, things like that. So as an investor, when there's a lot of opportunities coming up, or anytime, you always want to know, where are you getting your capital? And, banks, traditional lending, hard money lending, non-recourse loans, private money lending from individuals is, a lot of individuals might be a little scared right now. They might be tightening up, but a lot of people, just kind of based on their risk assessment, their personal, personality, there's going to be a lot of people willing to move money over into a self-directed IRA to place that into a tangible and secure investment. Because again, a lot of people have really been hit hard by the stock market losses these past couple of weeks. So keep in mind that as a lot of people are losing their jobs, losing 401k values, there's going to be a lot of opportunity for you guys as real estate investors to be a helping hand and just kind of go out and start that conversation of, hey, you got laid off? I'm really sorry to hear that. What are you doing with your 401k? I've got some investment opportunities coming up, and just kind of know how to start that conversation, have a good base knowledge of it. And then I always tell people, you don't have to know everything that I know. Just know how to pass off the conversation to me. Once you get to a point where they're interested, they want to learn more. A lot of people feel really, really comfortable hearing all of the information from an expert that is a neutral third party. And that is exactly my role in the situation. So as a lot of these IRAs and 401ks are recovering from these stock market losses, a lot of them are going to be in recovery mode right now. But there's going to be a lot of people that now have access to their 401ks that are looking for alternative investment opportunities. And again, as an investor, having a good base knowledge of how self-directed IRAs work can have a huge impact on not just your own retirement and the investments that you're able to grow within your retirement account, but you have a huge potential to really help other people out. If they're in need, they're going to be looking for ways that they can, sleep at night because they know where their money is invested. So you guys have a really big opportunity to help a lot of people out. And in turn, that gets you a lot of private capital for your deals. And investment opportunities for your own IRA, kind of covered that already, but you want to prepare yourself with the right knowledge now while things are kind of slow. I know a lot of people have slowed down. A lot of people haven't slowed down, but now is the time to really educate yourself and, really foster and, kind of grow these relationships with people. So once these opportunities do come up, once things start happening and really taking off, you've already taken the time now to prepare yourself for that. And I think I just pretty much covered everything on this slide. I knew it was coming up, but I was kind of in my groove. So what should you be doing right now? Align yourself with the right people and focus on growing and strengthening relationships. Learn as much as possible, especially about self-directed IRAs. There's so many ways that you can benefit from them. And I'll walk you through it step by step. Keep an eye out for opportunities on the horizon and be ready to be flexible and pivot if needed. If you're not ready now to be flexible and pivot, you better start moving because, things have already changed so drastically. Just the mere fact that everyone's working from home, and, a lot of people aren't working at all right now, there's going to be a huge opportunity. I heard someone a couple of weeks ago relate it to the stock market, where when the stock market crashes and people get scared and they sell off their investments, they pull out, they sell those, they don't want anything to do with them. They're operating at a loss there. For every person that gets scared and sells those stocks at a low, there's going to be someone else that comes in that sees the opportunity there and buys it for, the more kind of long-term growth and opportunity. It's the same exact thing with real estate. So just be ready to be flexible and pivot. And last but not least, shameless self-promotion, schedule a free consultation with me. That's my email, haley.gant@questtrust.com. I really want to help you guys. I want to help you all as much as possible, just to kind of know about all of your options. And what do I want to do to help you guys get started? I'm like, right on time, got 3 minutes left. I know that things are slow right now. I know a lot of people are waiting to see where the market goes. And normally as an IRA custodian, April is one of our biggest months of the year. That has obviously changed a little bit this year. So to help kind of give an added incentive, we are waiving our $100 account opening fee for the entire month of April. But I also, I didn't exactly get approval for this, but I did it anyways. If you're one of the first 10 people to email me and set up an account after this webinar, in addition to waiving your account opening fee, I'm going to give you $100 in fee credits. So and I'll let you guys know this now, if you have an account open at Quest and it's not doing any activity, no investments in there, the only fee to have that account open is $25 a quarter. Now, once you start doing investments, we have other kind of general administrative fees. But basically what this means is with this added $100 credit is you have up to a year to decide what to do with your self-directed IRA at Quest before it's really going to cost you anything. If we go through a consultation and you call me 6 months from now and you decide, hey, it's not really what I want to do yet, just let me know. I'll close out the account, not charge you anything since it's never been used. But the reality of it is there's going to be a lot of opportunities coming up. There's going to be a lot of people looking for capital, looking to place their money for somewhere. So I want to give you guys an incentive to get it started, get your money moved over, because when these investment opportunities pop up, you probably want to make sure that you already have your account established and at least somewhat funded. You don't have to move everything over to Quest, but move some of it over so that way when a deal comes across your plate, when George emails you and he's got an investment opportunity, you'll be ready to go. If you haven't done that and an investment opportunity comes up, Quest is very fast on our end as far as opening up accounts and processing investments, but the process of moving your funds over to Quest from your current custodian can take anywhere from 3 to 5 business days to 2 to 4 weeks, just depending on where the funds are coming from. So I have seen it a lot where people will actually, unfortunately miss out on an investment opportunity because they were waiting for the opportunity to come along to get things started. But, for right now, it's honestly going to be cheaper for you to open up the account, no account opening fee, an additional $100 account credit for any future fees. But it's only for the first 10 people that email me to open up an account. So I hope you all take advantage of that. And that's really all I have for you. We do a ton of education on our Facebook page, Zoom. We've got a lot of stuff on our website. So that's my email right there. Do my one last slide. We're on Facebook, we're on LinkedIn, we're on YouTube. I'm all over Facebook. If you guys see Quest on Facebook, you're probably going to see my face a lot on there. But if you guys have feedback or any questions or anything, just let me know. My job is to help you know all of your options to save more for retirement in a more secure, safer, and easier way. And that's all I've got. I hope y'all enjoyed it.
Thank you, Haley. You packed a ton of information into that.
I tried,
thank you for that. A ton of our investors use Haley and Quest. So Haley's going to stick with us. If you guys think of any other questions, just go ahead and put it in the chat. We're going to bring Dugan on now so he can tell us about some of the legal things that go on. Go ahead, Dugan, take over.
All right. Hey, everybody. So as George told you, I'm a lawyer by background. So a little bit about why should you listen to anything that we have to say. I've been a lawyer and a litigator in particular in the area of commercial real estate and commercial transactions for over 20 years. We have offices in the greater Los Angeles area and Dallas-Fort Worth area. I'm talking to you from Dallas-Fort Worth today, but George asked me to talk to you all about what happens in the event that you've invested in a syndicated multifamily offering, passive investor, and most of you, if you've invested passively, you've either invested into what we call a limited partnership structure in which you are a limited partner and the general partner is making all the decisions in connection with the asset. Most of you have invested in what we call a limited liability company, and you are a member of that company. You're a passive investor. So what happens when the manager of that limited liability company, which is often the sponsor of the deal, isn't able to make the debt service payments because the economic vacancy, meaning the tenants at the property, are unable to pay their monthly rent through a variety of reasons. Maybe they've been laid off or furloughed. Maybe some of them were asleep at the switch and didn't ask for stimulus checks. Maybe the people that got the stimulus checks they've held on to them and they have their rents. The good news is we're not seeing a lot of that. So nationwide, last year, our office did over 700 million in structured transactions. This year, we were on track to do more than that. So clients from all the way from coast to coast, and many of them that I've spoken with have said that collections came actually pretty good. So in other words, debt service payments, the sponsors, the managers of that LLC, your managers as a passive investor, did not miss any debt service payments. Most of them, this is true. Okay. So what happens like George said, what happens the next month? What happens in May or June? Well, it's probably time for you to dust off that operating. So most of you that invested passively, you invested through what we call a private placement memorandum. You received an offering docs. Well, part of that big packet of materials, usually a couple hundred pages long, was what we call an operating agreement. That's the governing document that controls essentially who has obligations and rights in connection with the apartment building or the commercial real estate asset that you've invested in. You've purchased an interest in a company. That company owns the real asset. So that operating agreement is what essentially controls whether the manager has the ability to call a cash call. Cash call is something that is available for people that control the entity to essentially say to passive investors, hey, listen, our tenants at our properties are not paying rent. We're going to be short, and we haven't entered into a forbearance agreement, or the bank hasn't basically agreed with us to stop our obligation to make that monthly mortgage payment. What do we do? Well, one of the options available to every manager or controlling member is to have a cash call. And what does that really mean? Well, what it generally means is that there's going to be a notice. Usually it's a written notice. The specific notice provisions and how you receive that notice will be set forth in your operating agreement. One size fits all, okay? Some provisions may require you to be personally served, meaning a process server showing up at your door and actually giving you something in order to say, we're going to have a cash call, which is either a physical meeting or a meeting that you could attend Zoom or some sort of other electronic means if that's set forth in your operating agreement. If your operating agreement has a much looser notice provision, that notice provision may be simply an email that has an attachment that says on such and such date. Usually those meetings can't be set earlier than 10 days and longer than 60 days. So somewhere, and I'm just talking in generalities because I don't have all of your operating agreements in front of me, but your operating agreement will have a notice provision. It will have a cash call provision. It may have other provisions you need to know. But assuming that it's generically and the manager wants a cash call thing, you'll receive that notice in the mail or by personal service or through email. And it will set a time frame within which they're going to have that meeting. Set an agenda. It'll basically say something like, we need to have a discussion. We need to have a frank discussion. This frank discussion is going to be around the fact that economic vacancy at our properties has gone up and we're unable to make the debt service payments. And as a result, all of the members, theoretically, we're going to have a vote. And that vote is going to determine whether the passive investors essentially have to put up additional money according to the pro rata percentage of ownership that they own in the entity that owns the commercial asset. Well, most of your operating agreements will have essentially what percentage of vote is required. It's not unanimous. In most cases, it's not unanimous because think about it. That would tie the hands of the manager such that if they didn't get unanimous approval from all the passive investors, they wouldn't be able to have a cash call. And as a result, potentially the asset could fall into default. So you might have one investor out of 100, 150, 200 investors that theoretically would block that cash call. So typically, it's either a majority or a supermajority vote of all the members. So if you've invested in a deal and it's a 70-30 split, 30% of the vote is already owned by the managers. That means managers have a simple majority vote according to your operating agreement. Then really all they need is 20% of the passive investors, 20%, a little over 20% of the passive investors to essentially vote in favor of the cash call, and the cash call will pass. So you really need to look at your operating agreement and what the percentage of vote is and what your notice provisions are. Okay, so if you've looked at that and it's a majority vote, let's just assume hypothetically you get a notice in the mail from the sponsor or the manager. It says we're going to have a cash call. Here's when it's going to be, and you've looked at your notice provisions. They've timely provided you notice, and you know exactly what the percentage of voting is going to be. You show up to that meeting. Most, not all, but most operating agreements will say passive investors do not have an obligation and an absolute obligation to fulfill the cash call, meaning the passive investor is not going to be obligated to actually 10 their pro rata percentage. But here's the catch. Here's the catch. Most operating agreements will allow that the passive investors that do fulfill their obligation after there's an affirmative vote. So the says, let's have a vote. It's a 70-30 split. The manager obviously is going to vote for it because he or she is the one that called for it, right? And they are able to obtain the additional percentage of votes by the passive investors. The manager says, okay, we've got the votes. Everybody has to belly up to the bar and put their money in according to their pro rata percentage. That's what a cash call is. Now, what happens if some of you as passive investors say, well, I don't care what the vote is. I voted no, and I'm still voting no. I'm not gonna pay. Well, then most operating agreements, again, this will be fact specific to your deal, will say that you will be diluted. Okay, let me say that again. If you don't participate and your company agreement allows the manager in the presence of an affirmative vote for a cash call, and you as a passive investor choose not to participate, then theoretically you will be diluted. And that seems fair, right? Because theoretically they can't force you to participate in that cash call. But if you choose over the vote, you were timely noticed, not to participate, it doesn't seem fair for you to be able to piggyback off of the other passive investors and the other members of the LLC who actually do participate. So the only recourse theoretically for the manager is not to remove you. You will not lose your membership, okay? Be kicked out, that would be very atypical. Instead, the most common recourse is that you will be diluted, meaning you lose some percentage of your ownership, and the people that actually did participate will then, their ownership will increase, okay? That's one thing that is possible in times in which the manager is unable to make monthly debt service payments. What's another option? Well, one other option that we see in times of economic strife and uncertainty and an inability to make the monthly mortgage payment is that the manager asks for loans, intercompany loans, meaning some investors may say, hey, I'm not interested in a cash call, or maybe the manager doesn't get the required vote. Remember, the manager has to call a cash call meeting. What happens if they don't get the vote? Well, their secondary position often is to say, okay, not everybody wants a cash call. How about the investors that did vote for the cash call? Would you be interested in loaning us money, a short-term advance, if you will, at a usually higher interest rate? Typically, the interest rate that's set for those types of loans is higher than what debt service is to the bank. In other words, there's a preferential treatment, a higher interest rate that you would get other than leaving your money in the bank right now. So you're incentivized as a passive investor to actually think about that, right? Because you've already identified that this is a solid asset. I agree with George and Eric. Multifamily commercial assets in the United States are some of the safest, most reliable commercial assets going today. Why? Because they're in large respects, your risk is diversified over a platform of multiple tenants. It's non-recourse debt, meaning that the in Wall Street have already banked on this being a profitable performing asset, much more so than commercial strip malls or office space or other commercial real estate assets that are recourse. Multifamily instead enjoys almost supremacy in the area of non-recourse debt. It's one of the only assets out there in which you can invest, in which the banks actually are underwriting, not people that are essentially in the property, they're underwriting the properties as a whole. And so if you're an investor and you've already bought in, you've already invested, and you know that we're going to get out of this in a couple months, your thought process may be, hey, I might make more money earn more money on making my money work for me by offering a short-term loan to the managers. So that's one other option that managers have that maybe you haven't thought of, and you need to look at your operating agreement, is they may actually have the right to issue additional new securities, right? So remember, you bought into an LLC, that is a security, okay? You own a piece of a company. That company owns a large commercial real estate asset, much like an apartment building. That's a security. Well, in the event like that the manager doesn't get any traction on cash call, the manager doesn't get any traction on loans or advances by other members to the company, the manager has to think about, I cannot let this asset be foreclosed upon. The manager has to do everything within their power to make sure that the asset does not get foreclosed upon and that the investor's money is lost, because that is absolutely of any investment. Losing your money is absolutely a known risk of any investment. There are no guarantees. But as the manager has a fiduciary duty of care and of loyalty to, first and foremost, make sure that the asset is protected, that it does not get foreclosed upon. So manager calls a cash call, doesn't get any traction. Manager tries to gin up some interest in potentially getting a short-term loan from one or more of the deep-pocketed investors, doesn't get any traction. Well, then the manager theoretically goes back to their counsel and says, hey, I'd like to do another raise. I think that there are other people, third parties out there. Maybe Haley's got some people with self-directed IRAs that might want to invest in this opportunity, right? How do they do that since they don't currently own a piece of the entity and the raise is over? We've already owned it. We've owned the asset for a year or more, and so our initial raise is over. Well, what does the manager do? Well, the manager does a new raise. So they create an offering, and that offering goes out to potential people, and they contact people in their existing network, and they do additional offering. Well, if they have to do that, then as you might imagine, what's the downside to you? Well, you get diluted again, right? Because think about this. They're creating new securities, which means that they're essentially going to cut up the pie just in smaller pieces to sell off to potential investors out there to raise the cash or to get through this period of time. So again, your operating agreement will set forth that possibility. Now, if they don't want to do that, simultaneously, you as a passive investor should be and often have conversations with the manager about this concept of forbearance, right? So many of you that have read the CARES Act, or any of you have read the CARES Act, the 1,000-page word is that, right? It's thick, really, really thick, like 3 or 4 times the size of a normal offering. Put most of us to sleep. Well, a part of that is this concept that if you have if you're invested in a property that has a federally backed loan, meaning Freddie, Fannie, or HUD, the president, through Congress, has passed a provision of the CARES Act that essentially right now there's a moratorium on evictions. That's why, as managers, passive investors, we're all a little tense, right? Because if tenants at our properties start to really think about it, we're afraid that maybe they will know that we cannot evict them right now, and that we can't get them out of there. So maybe they'll stop paying rent. That's the biggest fear going on. I think theoretically it's largely unrealistic, depending upon the property and where it's located, and a lot of different factors. Specifics in large part because if those people in B or C class properties are eventually going to get evicted, their deposit is taken because they obviously owe us rent. In large part, those people will have no place to live. Okay, let me say that again. Those people will largely have no place to live, and they have to get back in the market. So we don't all have to work somewhere, right? We can work in our homes. We're all, to a certain extent, we're sheltering in place, right? You're peering into people's homes even now through webinars and podcasts, right? You're seeing that they are there. They're in their own environment. Well, we don't have to go out and work somewhere. But people, when they lose their home, they still have to have that last security deposit. And if their cash reserves have been depleted and this money has been gone, it is very short-sighted. That's why I agree with what Eric and George said. Communicate with your tenants. Communicate with them from a standpoint of, listen, we don't want to have to evict you. Understand that at some point, this moratorium on evictions will let up, and you will be evicted if you do not pay your rent. So if you cannot pay 100% of your rent, pay a portion, or at least have a meaningful dialogue in connection with that. And most seasoned operators have conservatively underwritten their properties so that they can tolerate some amount of economic vacancy. So if you're a passive investor, kind of understand what that underwriting looks like so that you know that if your collections are, let's say 70, 75%, yes, that is a drop. Yes, that's not great. But theoretically, the operating capital, the cash reserves, and the conservative underwriting have assisted you that you can tolerate that economic vacancy and you can still meet your debt service payments. But what happens in the event that you can't do any of this stuff, right? Well, there is this concept of forbearance. And what that really means is we contact our servicer. So, or the lender that actually is managing our loan, and we contact them. The manager will then say, hey, listen, we're experiencing transparently, authentically, honestly, we are experiencing high level of tenants not paying their rent. What can we do? And often those servicers or the lender will say, we will enter into a forbearance agreement. The terms of the forbearance agreement, what forbearance means is simply push pause. The lender's going to push pause on their right to collect rent for a specific period of time or a specific trigger. It could be when the restrictions of COVID are let up, or within 3 months after that, or something else. It will be according to the specifics of the forbearance agreement that your manager will be reading and looking at and evaluating. The downside to forbearance is this is not a waiver, okay? This is not a waiver of rent owed or mortgage owed on behalf of your company to the lender. It's a deferral. And what often happens is then it will be packed into a more compressed time frame, maybe a year, maybe 18 months, and it will be chopped up in equal monthly installments and added to the existing mortgage payment. So forbearance, I agree with George, is not something to be taken lightly. But if you think that this is something, and you're an operator or a manager, and this is something that you think that you might take advantage of, now, later, not when it's a 3-alarm fire, now is the time to strategically be having those discussions to think about it. Like, under what circumstances would we approach our servicer? What does that look like? Even engaging in dialogue. What are the due diligence list of items that the servicer or the lender will need from us in order to evaluate whether we can enter into a forbearance agreement, and what are the terms that the lender is going to be looking at from us? So those are some of the options that are out there. Again, this is not going to go on forever. Okay, I agree. I'm bullish on multifamily. I think that it is a great place for you to park your money. Anybody that thinks that the stock market is more reliable, take a look at it from just the last month. It's up, it's down. I mean, there was a swing of 2,000 points in one day. What? That's insane. That's insane, ladies and gentlemen. So think about something that will provide cash flow, long-term appreciation plays. I agree with Haley. One of your best assets that's sitting there and earning not enough money is money that you have sitting in an IRA that you can deploy now. This is now. Now is the time when players that have been sitting on the sidelines are actively hunting for deals. We are writing purchase and sale agreements actively on a daily basis for people that are strategic in their thinking about making acquisitions around the United States. Why? Not because they're dumb, because they're looking at huge opportunities at this time frame for people to get into the commercial real estate space, in particular. So if you're passively invested in a property right now and you think that the property may be having issues, pick up the phone, send an email to your manager, dust off that operating agreement, understand what the notice obligations are, understand what the cash call obligations are. Maybe there might be a loan opportunity for you to tap into, or to have a discussion with the managers about whether they might issue securities. And if all else fails and you're in a really tight spot for a period of time, forbearance is always on the table. Banks are not in the business of owning and operating real property. They're in the business of loaning money, okay? They're not in the business of owning your asset. That's not what they're looking to do. They don't want to foreclose. They want to figure out a way that makes it work for the economy, for their shareholders, for their investors. And ultimately, if you just kind of look at that and have open dialogue with your sponsor partners, that will be most helpful for you.
Awesome.
Back to you, George.
That was great information. I think as far as an operator, there's a lot that can be done right now to not get into those situations that you just talked about. I think first thing is you definitely need to know your break even. At what point, like you said, your economic vacancy, at what point are you no longer making your debt payment? And then kind of work backwards from there and see, communicating with the residents, like I said before, is super important. We know every single one of our residents, what situation they're in right now, whether they have a job or they don't, whether they've gotten their stimulus check or not. And you've got to take the time to do that. The PPP loan is super important for property management companies. They need to be applying for that. Your property management company, if it's a third party or if you have it internally, because you could essentially get your payroll covered for 2.5 months, which would be super helpful right now. So yeah, I mean, like I said before, I'm pretty positive about this whole situation. I think we're going to get out of it. I think we can avoid a lot of the things that you mentioned. I did want to, since we got Eric on now.
Can you guys hear me?
Yep.
Okay, cool. Sorry, I was having technical difficulties earlier, but so actually, just to piggyback on what Dugan was saying, is that this is not going to last forever. Actually, I was just looking at while everyone was speaking. I think Trump is, and George mentioned this earlier, he's got a plan to reopen the American economy, and I figured we just talk about it today. But it comes out in 3 phases. I'm going to read these real quick. But phase 1 calls on employers to telework where possible, return to work in phases, minimize non-essential travel, and make accommodations for the vulnerable populations within workforce. And obviously, there's more details to all of this, but that's phase 1. Phase 2 is non-essential travel for employers can resume. Schools and organized youth activity can reopen. And then phase 3 is bars, gyms, and large venues can reopen with limited social distancing and proper sanitation. So obviously, there's going to be a ton of rules and regulations that go around these things, and everyone's going to have their opinion. But I think Trump is giving these plans to each governor, and the governor is going to make, in their respective states, and is going to make decisions based on, how many people are infected and the infected rate there to start reopening things. So I think all of us are pretty hopeful that, we can at least start seeing the light at the end of the tunnel now, and things will start, reaching normalcy pretty soon. So I just wanted to comment on that because I think it's pretty important. And I think Trump is speaking either now or in a few minutes. But somebody sent me this article, and it was, it's, I mean, that's the most positive news we've heard because we've been shut down for, I don't know, it feels like 2 years already.
No, that's the plan I've been talking about. I wanted to see some type of plan. Obviously, there's no dates to any of that, I guess. You're saying it's going to be the governor that's going to.
Yeah, I think he's going to be speaking about it, but I think it's going to be, this is what Trump has given, governors, and the governors are going to be making the decisions based on, the results that they have in their state. So, probably some places like New York or Florida or California probably are not going to open as quickly. Places like Texas will probably, I think we all agree Texas runs a tight ship with everything, and we'll probably be one of the first states to open up, hopefully. So we'll see how it goes.
Well, Eric, before you keep going, man, I just wanted to once again thank Dugan and Haley. You've got their contact information right here. We'll also go ahead and send you these slides afterwards. And if Haley wants to give us her slide as well to send, we can do that. Okay, cool. And then I know, speaking of opportunities and seeing the light at the end of the tunnel, I think Eric wanted to talk about our current opportunity.
Yeah, well, before I actually get to this, I actually have some other news, and I wasn't aware of this. Maybe you guys, some of you may already be aware of this, but for those of you that, obviously passively invest, with your IRA or 1031 money or just your regular, cash, I just got a notice that the IRS extended the 1031 timelines for, they're extending timelines for 1031 exchange buyers. So I'm not sure if that's new news or not. It was new for me, but I'll just read this. It says, under new guidance, both the identification and acquisition of the replacement property or unplugged has been extended. If identification deadline falls between April 1st and July 15th, then the new deadline is July 15th. Likewise, if the 180-day purchase deadline falls between April 1st and July 15th, the new deadline is moved to July 15th. So basically, you're going to have more time to place your money and investments, which I think is huge, right? Because I know we spoke to a couple of 1031 people, and they were kind of freaking out as to what they were going to do. But, I think this country has done a good job with, extending tax day, extending 1031, time to accommodate the crisis that we're in. So anyway, so going into just kind of Isabella, it kind of ties into everything that we've been doing. This is our newest acquisition in Oklahoma City, and I won't spend too much time on this, just kind of give you a rundown. Like everyone, we've been adjusting, right? We were supposed to close on this deal at the end of March, but then at the last minute, lenders started to back out, and they said, look, we're not necessarily backing out, but we're pressing the pause button on things. So we've kind of had to readjust. We've had to go to the seller. We've had to ask for an extension of 90 days with an additional 30 days because we just didn't know what the future was going to hold. And it was really just the uncertainty of that, right? And now, now that we have an extension, as far as, what type of leverage are we going to get now, prior to pre-COVID-19. So, those things may change. And, we're just like we're keeping in constant communication with our tenants as far as what they're doing and, do they have jobs and can they pay rent? We're doing the same things with sellers. We're letting them know that we are doing the best we can to, to find debt and put the pieces back together. But at the same time, we're letting them know that, like, look, we're dealing with a once in a generation type, thing, hopefully, right? Hopefully we never see this again, unless we just see it in the movies. But, hopefully we never see this again. But, I think sellers are aware of what's going on, and, they're going to be more reluctant to work with us, right? If they want to get the deal done, sometimes you're going to be dealing with an unreasonable seller, which makes everything harder and makes life harder. But thankfully for us, we're dealing with a reasonable seller that understands the business, and we're going to get it worked out. But right now, our biggest concern was time, just to be able to weather out the storm and figure out what we were going to do. But anyway, this investment, it's 850 units in Oklahoma City. And obviously, we know a lot of people are kind of, on the sidelines right now. And that's normal, right? We're kind of on pause too, and kind of waiting to see how things are going to play out. But we feel that now that, Trump has a plan to, reopen the economy, it may be time to kind of start talking about these things. So, anyway, this is, and some of you already may know about this opportunity, but it is in Northwest Oklahoma City. It's a beautiful asset. one thing about it is that the occupancy, the opportunity here is really a lease value add play, because the occupancy has dropped down to 50%. And that was because a combination of bad management, number one, and number two, he was running like a corporate hotel structure out of the apartment complex. And then, after the government shutdown in 2017, he was specifically marketing to the Federal Aviation Administration, which is where he was getting the majority of his corporate tenants, and he started to lose those. So, anyway, we found a tremendous deal with a tremendous value add. It's not a very heavy lift as far as CapEx, but it's really a lease operational play, right? And the things that we like about it is that it's just 7% vacancy is in the area. Obviously once we get past COVID-19 stuff, I think our timeline may be extended a little bit, but we can still reach stabilization pretty quickly. I think we were aiming for 6 to 9 months, and that may look like more like 9 to 12 months after this, after we get past COVID-19. But anyway, great returns on this deal. We're still offering an 8% preferred return to our investors. We're not, changing any of that. 70-30 splits. I think Dugan had mentioned that those were traditional splits in syndication models, and that's still what we're offering. Our investment is about 100 grand. We do have 90% of the equity already raised, which is fantastic. Even in this difficult time, we still have 90% of the equity raised and committed, and they haven't backed out, and that just speaks to the strength of the deal. And we're down to the final 10%. So our biggest challenge is getting the last 10%, and then finalizing what we're going to do with our debt. So we feel like this is a great opportunity, and we have time, right? So realistically, we'll probably be getting this thing closed sometime in June, towards the end of June, and if not potentially earlier, if things start to move quicker than anticipated. We feel like people will still kind of be reluctant to go full force, but I think once things start to open up, we'll probably be at maybe 75 or 80%, and it'll probably take a while to get back to 100%. But just like everyone talked on the call today, I think there's reason to be optimistic here. This by no means has felt like the 2008 meltdown that we had. I actually watched The Big Short the other night just to kind of do a refresher. And if you guys haven't watched it, it's a great movie. Watch it. This feels more like a 9/11, and hopefully it was just kind of a short stint for us. But if you guys are interested in this project, we'd love to to talk to you about it. Obviously no pressure. We know that things are kind of volatile right now, but we still feel good about this investment. But if you haven't received the investment summary, feel free to reach out to us. We'll send it to you, and if you have any questions, we'd be happy to discuss it with you. But like I said, great returns. They haven't changed. We have 90% of the equity raised. Excuse me, and we're looking for the final 10%. So, if you're looking to get involved in something and something that will have great returns, moving forward once we're out of this mini recession, if you want to call it, we'd be happy to have you as a partner in this deal. So that's really all I got. I didn't want to really do any crazy sales pitch here or anything. Just kind of give you a brief overview of what we have going on as far as our deals and just future deals. We're actually still looking for new deals. But everything that we're making offers on or talking to brokers on or even talking to sellers direct on is, all right, number one, we're not doing hard money day one anymore. We're doing a 90-day due diligence, and we want a 120-day financing contingency. So stay tuned. We actually have maybe a potentially another 1,300 units coming up in Houston that we're working on, and a couple other deals that are in sight that we feel will be good opportunities. But we want to play it safe, right? It's always better safe than sorry, and that's what we're doing kind of on the acquisition side on our end. So that's pretty much all I had. Appreciate everybody for being on the call. And I don't know if we want to wrap things up. George, if you have any last words. George, I think you're on mute. We can't hear you. Or at least I can.
No, yeah, I was on mute. I was just saying that on the right, they should have a tab that says offers, and they can click there and get more information, open a new tab, and give them more information on this investment offering. And then just to kind of wrap things up, we've got our sponsors. We highly appreciate them, with Quest and Haley and Dugan being one of those. I want to thank them for coming on and giving us awesome information. And then the last thing is, actually, there's one more thing. Sorry. So one thing we're going to be doing with our new investments, if you do invest with us, we're going to start having monthly conference calls, and kind of for the investors that want to know more about being on the operation side, we're going to start doing almost like monthly trainings and giving them more information than you would usually receive from an operator as a passive investor. So I just wanted to get that out there. And then we should also be we've been really trying to think of how to continue the networking. I know Haley was talking about this earlier. You know, she loves networking and it's pretty difficult right now. So we're thinking of a way of doing a webinar where we can break into different rooms, smaller rooms of maybe like 8 within the webinar, and then kind of float around the room. So I think that's going to be our next event. Stay tuned for that. Pretty excited about that one. Get back to some networking. And that's it. I mean, if you want to contact us, you've got our email there and our website. Reach out. Haley and Dugan, I don't know if you have anything else. I don't see any questions, I don't think.
Nope, nothing else. But thanks for having me on today. Definitely enjoyed it. And, you know, again, if you guys have questions, reach out to me. I'm always here to help out wherever I can.
Thanks, Adam.
Thank you.
Awesome. Thanks for having
Dugan,
us
you
today.
got anything?
No, just stay safe, be well.
All right. Bless y'all. Yes, everybody stay safe.
All right. Have a good evening, everyone. Thank you.
Yep.
Bye.